Okay, listen up. There's a historic signal flashing right now in precious metals, and it's screaming about an imminent, almost vertical surge in silver.
Yeah, it's intense. Gold's already had a huge run,
Hmm.
smashed through $4,300.
And silver. It hit $53, but it's that wild volatility, the swinging price. That's the real story here.
hmm That's not weakness, that's tension building.
Yeah.
We've been looking at analysis from Michael Oliver. He's one of the top technical guys out there.
Right.
And his latest work shows this unique signal suggesting silver is basically ready to blow its cork.
So our focus today is breaking down his argument. It's all about the silver to gold spread, right?
Exactly. And why this volatility, this specific pattern, it's the same thing that happened right before every major silver breakout in modern history. This is big.
This is really about market momentum snapping. A generational signal, maybe? If this sounds critical to you and you need this kind of analysis regularly, you really should subscribe to Credvia now. They track this stuff closely.
Okay, so let's get into Oliver's main indicator, the silver to gold spread, the SGS.
Sounds technical, but it's pretty straightforward.
Yeah, super simple on the surface, silver price divided by gold price as a percentage. That's it. But that ratio, it holds the key.
Looking back, 2020, the spread hit 1.5%. I remember that. Seemed like a big deal for silver then.
It did, but Oliver says that since then, silver's been making a grand mistake. It's lagged gold badly.
The spread dropped.
Dropped in layers. Fell below 1% again back in April. That's really low, historically speaking.
How low? Like, what's normal?
Well, Oliver points out, over the last 50 years, the spread's been at least 2% for 20 of those years.
20 years. So 2% isn't the peak. It's more like the average fair value.
Pretty much, yeah. The historical norms. Right now, silver's trading at roughly half its long-term relative value. Oliver calls that mispricing the grand mistake. It's like it's off by 100%.
Wow. Okay, so the market's trying to correct this. It's moving up. But what's the specific trigger, the technical point Oliver's watching?
It's a green line on his chart. The structural resistance sits at 1.31%. Breaking that level on the spread chart, that signals the start of the big catch-up.
Right, 1.31%. But Oliver's known for looking at momentum before the price breaks, isn't he?
Exactly. And this is where it gets really interesting. He tracks the spread's momentum, not just the price. Uses a long-term measure, like a 40-week average as a baseline.
So measuring the underlying flow, the institutional mood, not just daily noise.
You got it. And that momentum chart, it's already ahead of the price.
Oh, how so?
Well, the price spread is still climbing towards that 1.31% structure. But the momentum chart, it already hit its own breakout point, pulled back a bit, tested it, which is good,
How
healthy.
good now?
Now it's heading towards that breakout point again. Oliver's rule is simple. If momentum ticks up more and breaks out cleanly, the price spread will follow through 1.31% very soon after.
Okay, that momentum break is the real heads up then.
That's the critical signal.
And history tells us when the spread finally breaks, silver doesn't just gently rise.
No way. That's the crucial part. It doesn't climb, it erupts. Oliver keeps calling it a parabolic, violent move.
And we have examples.
Crystal clear ones.
Yeah.
2 major precedents with this exact setup.
Okay, lay them out. Case study 1, late 1979.
Yep. The exact structure, the same spread behavior we see setting up now, it appeared right before that massive explosion.
That was the Hunt brothers era, right? Silver went crazy.
It did. Surged from around $5 to $50 in about 6 months. Chaos, panic buying. Yes, the Hunts were involved, but the technical signal was there first, showing silver was just fundamentally way too cheap relative to gold.
Okay, precedent 2, more recently.
September, October 2010, same pattern.
Yeah.
Silver was upper $20.
And then?
Spread confirmed the momentum break, and boom, $50 by April 2011.
So in both cases.
In both, gold and silver took off. But Oliver stresses this. Silver bent the pants off of gold because the spread confirmed that massive mispricing was correcting.
And these moves were fast.
Very fast.
Yeah.
Intense. Both lasted about 6 months.
Okay, but I have to ask. Those spikes, especially 79 going to $50, weren't those like speculative bubbles? Is Oliver saying hitting a 6% spread like back then is normal, or just an extreme outlier?
That's fair. And he addresses it. He focuses on the minimum target first, getting back to that historical norm, not necessarily the absolute peak mania.
So the signal starts the move, but the target is more grounded.
Exactly. The target is anchored in that long-term relative value. Look, if this kind of technical trigger analysis resonates with you and you want to be ready for what Oliver sees coming, you really need to be subscribed to Credvia. They give you this level of detail before the market moves.
All right, let's talk targets then. Starting conservative, we break 1.31%. Oliver expects a fast move up to at least that historical 2% norm.
Correct. Let's put numbers on it. Say gold just sits still at $4,000, and it's already over $4,200, but just say $4,000. A 2% ratio means $80 silver.
$80, just to correct that
Yeah.
gram mistake.
Right, just back to average.
But gold probably won't sit still if silver's going parabolic.
No chance. Oliver notes gold itself has done these huge 8-fold bull moves twice before, 1976 to 80 and 2001 to 2011.
If gold did that again,
Yeah.
what would that look like?
Could reach over $8,000 an ounce.
Okay, wow. $8,000 gold. And what does that do to the silver price calculation?
Well, a normal 2% relationship with $8,000 gold, that implies $160 silver.
160.
And that's just the norm. If the ratio overshoots, like it did before, it hit 3.5% in 2011, it spiked to 6% back in 79-80.
So if it overshoots with $8,000 gold.
We could easily be looking at silver pushing $200, maybe more, in this next leg up. That's why that 1.31% momentum break is so critical. It signals the start of that potential overshoot phase.
And this isn't just a spike, he argues. Oliver uses this analogy with base metals, saying this creates a whole new price reality.
Yeah, it's a great comparison. Look at copper. It was stuck in a boring range for decades, like the 80s, 90s, right up to 2004.
Right. Low prices forever.
Then bang, it tripled in just a few months.
And the key thing is it never really went back down to those old low levels, did it?
Never. That surge set a new floor, a new reality. Copper's base price became like double and a half the old price.
Yeah.
Lead did the same thing, jumped from $1,200 to $3,600 fast, established a new, higher reality that stuck. Double, triple the old floor.
The market just accepted a higher value based on, what, inflation, supply issues?
Exactly, underlying factors. So applying that here, Oliver's basically saying silver is stuck in its 1980s price basement right now.
And this breakout isn't just a quick visit upstairs, it's moving into a new, higher floor permanently.
That's the core idea, a structural re-rating,
Yeah.
like copper and lead already had. Silver's next. The question is, why is it the last one? Why is it still so cheap?
Which gets to the fundamental reason why he thinks it's so mispriced. He calls it the most mispriced asset on the planet.
Yes, because it's completely failed to keep up with monetary inflation.
Oh.
Currency decay.
The numbers are clear there. M2 money supply doubling every decade. The dollar's purchasing power just collapsing over time.
Yeah, the decay since the 80s or the 2011 peak is massive, like 90%. And almost every other commodity, bread, beef, copper, lead, timber, energy, they've all adjusted upwards. They found their new reality reflecting that monetary distortion.
But silver, still stuck near its 1980 highs, adjusted for inflation or not.
It's an anomaly, he says, and it can't last. The fundamentals point back to real money reemerging. Silver is industrial, yes, critical tech applications.
But it moves mainly as money.
Primarily, it was money for 3,000 years. With fiat currencies failing, governments talking gold backing again. The big players know a crisis is coming.
And that crisis is the catalyst.
That necessary crisis jolts silver into its new reality, triggers the move the 1.31% spread break confirms. Oliver's warning is stark. You won't climb into this. You'll leap. It'll be too fast to chase.
Okay. Let's wrap this up with the key takeaways for you listening. Michael Oliver's analysis zeroes in on the silver to gold spread. Watch the long-term momentum first.
Right. A decisive break there signals the price breakout through the 1.31% resistance line is imminent.
And that technical sequence, if it plays out, historically kicks off a vertical, maybe 6-month phase.
It's wrapped up every major metals bull run we've seen. This isn't just another rally. It feels like a structural shift. Oliver calls it potentially the revaluation of real money in real time.
So here's the final thought, the provocative question for you. If Oliver's right, if silver is about to leap into a new price reality, now is the moment. Do you agree it's still the world's most undervalued asset after decades of inflation? And crucially, will you be positioned before this potential breakout or find yourself chasing it after it's gone vertical?
It's definitely a historic setup to watch closely.
Absolutely. Don't get caught flat-footed. Make sure you subscribe to Credvia. Keep getting these high-level insights on volatile markets like this. We'll catch you next time.